Hi and welcome. I'm really excited to share with you my presentation given at the Celebrating James MacKinnon Conference at Queen's University, Seize the Last Day, Period End Point Sampling for Forecasts of Temporally Aggregated Data. What's super cool about this is I'm going to show you high frequency forecasting techniques that are going to give you massive forecast gains, but allow you to change almost nothing about your model. Okay. So in particular, I want to talk about how we forecast macroeconomic data, okay? And macroeconomic data, things like GDP, quarterly effective exchange rates, real commodity prices, these are generally going to be averages or sums over time, okay? So, maybe we want to forecast the real price of crude oil, let's say. Well, this is generally going to be an average over daily closing prices, say deflated by a monthly CPI. Okay, so in macroeconomics, this is primarily what we're interested in, things like inflation, we forecast temporal aggregate. Okay, and this differs a little bit from, well, it differs from finance, because in finance, really what matters here is, say, the moment you purchase that asset to the moment you sell that asset. Okay, so we want to focus on points in time, comparing 2 points in time, but this really isn't that important in economics, right? Like if I am deciding between getting an electric vehicle versus an ICE internal combustion vehicle, right? I care about the total cost over time, maybe over the next 5-10 years, right? Every time I go to the gas pump, my costs are going to be the sum of every single time I refill. Okay, so the price of oil on any given day is not really that important for investment decisions, for physical investment, for understanding things like consumption and macroeconomic policy. Okay, so there's really no problem in macroeconomics. In fact, it's very desirable to focus on forecasting these aggregates, these time aggregates, right? This monthly and quarterly sums and averages of the data, okay? Now, the problem, though, is if we use these aggregates on the right-hand side of our forecast model. So in particular, we know that averaging can dilute the latest information in the data and can actually reduce forecast efficiency. So if you want to construct an optimal forecast, you need to use high-frequency information. All right. And in fact, this has very much been underappreciated. Even the statistics papers who wrote this originally in the 70s and 80s, they showed enormous gains, like 40-50% reductions in forecast error. But they also concluded it wasn't a big problem. How is that possible? Well, they weren't really focusing on the issues that macroeconomists are interested in. And when economists actually went to the data to try to test this, all they had to work with at the time was monthly and quarterly data. The problem with this is that both monthly and quarterly macroeconomic data are already aggregated. And all the information loss actually moves from a state of when going from no aggregation to aggregation. Okay, so like daily closing prices to say monthly and quarterly data. And so we published a paper this year in International Journal of Forecasting showing that these forecast losses from temporal aggregation are exactly commensurate with what was predicted by the theories in the 70s and 80s. And in fact, you can like half your mean squared error just by using high frequency information in macroeconomic forecasting. Okay, so yeah, I'm sure you would love to half your forecast error. How can we do this? Well, there's really two methods right now that are on the table. Okay, so I can use mixed frequency data sampling. So I have MIDAS, which is a great name. So basically on the left-hand side of my thing I'm trying to forecast, I have my aggregate, my monthly and quarterly data. And on the right-hand side, I have my high frequency information that I can use to construct direct forecasts. Okay, so this is one potential method. The second method is recursive bottom-up forecast, or what I like to call bottom-up forecast. So what are these? Well, the method is quite straightforward. It just says, well, don't ever aggregate when you construct a forecast. You estimate the model on the high frequency data, then you construct high frequency forecasts. So as a macroeconomist, this means daily. And you ex post average those daily forecasts to the monthly or quarterly frequency. And this should give you the optimal forecast, okay? The problem is, like, suppose you're a central bank and you have a quarterly DSG model that you're forecasting with. Well, none of these things are particularly feasible, okay? I can't just start estimating my DSG model at the daily frequency. Similarly, it's very cumbersome to try to add bridge equations and try to do direct forecasts with like a big structural model. No, this is not feasible, which is why people don't use high frequency information. But with being able to half your forecast error, people want to use this high frequency information and get these enormous forecast gains. So what do I do in this paper? Well, I propose a third method. It's called PEPS, or period end point sampling. Okay, and what this method allows you to do is estimate your forecast model at the monthly or quarterly frequency, still being able to preserve all the high frequency information and to construct an optimal forecast of the average. Wow, that sounds amazing. Let's see how we can do it. Okay, I'm going to give you a primer on temporal disaggregations, right? So I said there was this loss in forecast accuracy. Let me be very specific by what I mean for that. So just suppose we have like a daily autoregressive process with one autoregressive parameter, okay? So the value today is equal to the value yesterday times a constant, right? This is the autoregressive persistence row. And here I'm thinking about daily observations. So I is the day within the period T. So maybe it's like the first day of January, right? Where T is my January and I is 1, my first day of the month, okay? And so, you know, suppose I'm in the financial markets. Every day I go to work, this information epsilon arises. Maybe say oil prices jump up and they stay persistently high. Like OPEC makes an announcement or something, and there's persistent changes in some price in the market, okay? So what we are interested here is actually forecasting an average of this daily process, right? So the World Bank pink sheets, for example, this is all the commodity data. These are reported as monthly averages of daily closing prices, okay? So what we want to do is forecast these monthly averages of daily closing prices, and we can just construct a forecast target by just taking a monthly average of the daily data, okay? So this is my Y bar. Now, where does the information loss come from? Okay, so if you can understand this graph, you can understand temporal aggregation bias. Okay, so here I'm just plotting the impulse responses from that AR1 process. Okay, and in particular here on the horizontal axis, I have the days, and I'm just assuming that my month goes to 21 days. Okay, business days within the week. Okay, so excluding the weekend. So the issue is about the timing of that information within the month. So if the shock happens on the very first day of the month, right? Suppose OPEC makes a surprise announcement. We're gonna slash oil production. Okay, prices of say oil are gonna jump up right away and they're gonna stay persistently higher. And here I just have an autoregressive parameter of 0.98, and they stay persistently higher throughout the month. Okay, no problem. As you know, the World Bank comes along, takes that daily data, averages it, and you look at that average data, which is these dashed lines, and you can see that, you know, clearly the oil price has gone up in that month. You know, it has a sort of similar pattern to which that AR1 process occurred when it happened on the first day of the month, okay? Now, the problem is if that shock occurs towards the end of the month. So here I have an example with this gray line that the shock actually occurs on the last day of the month, right? So OPEC makes an announcement on the last couple of trading days, prices respond right away, exchange rates adjust, everybody knows that this shock has occurred. And then the World Bank comes along, averages that data, and then we end up with this little meek line down here, which basically like dilutes all this recent information. Like this happened in this month, it's news, it's important to take account of, it's gonna matter for future prices, but we've just averaged it away, okay? So we've diluted all this recent information in the month with like stale, outdated information before that shock even occurred, okay? And this is the problem with temporal aggregation bias, which is that if things can respond quickly, the timing of the shock within that period is gonna be diluted, all right? That information is going to be lost. We're not going to be constructing our forecast from the most recent information, but we're going to be constructing it on some average of some stale information, okay? So what can we do? Well, we know how to construct a daily forecast with an AR1 process, right? We just need the last observation. We can construct a recursive forecast going forward, right? So we know how to construct daily forecasts with an AR1. And then the bottom-up approach, which is say, well, now that we have those forecasts, let me just average over those forecasts within that period, right? And this should give you the optimal forecast, right? This is what we're interested, should be the optimal forecast, okay? Now, one thing I need to point out is that one thing that's been recently discovered is that actually when you have the special case of a random walk, okay, so if the daily data is equal to the last period plus some random shock, right? So here, this is a very important case, right? Like this would suggest that the data is already perfectly forecastable, right? The growth rate of the data is going to be completely random, right? Just based on the error. And you shouldn't get any gains from model-based forecasts. Like this is the random walk hypothesis, right? In finance, this is the efficient market hypothesis. Like you shouldn't be able to predict this high frequency data, okay? And the important discovery recently is that when you forecast an average, you still have to compare against the last high frequency observation. So here, TN is the end of month observation, right? If we go back to our example with oil prices jumping up on the last day of the month, you need to compare against that end of month, no change, to test against the random walk hypothesis. And the amazing thing is no one knew this, okay? So even like people know that there's a problem here, but they didn't know how to proceed when we wanted to maintain the objective of forecasting the temporal aggregate, right? So even Menz and Rogoff, right, they're a really important exchange rate paper in the early 80s, they spent a whole page saying, we're gonna use end of month bilateral exchange rates because we want to test against the random walk hypothesis and avoid spurious predictability. But they also said, hey, guess what? Effective exchange rates have never been calculated at the daily or end of month values. We only have monthly observations. So we'll just forecast the average and compare against the average, no change. Well, turns out they weren't actually testing against the random walk hypothesis. So when they found all their theoretical models couldn't actually outperform the random walk, well, they weren't actually even testing against the random walk, right? That would have only been given by the end of month observation, okay? So this is really important. It turns out to be enormous difference. And I'll show you some examples later on. And it can literally overturn most macroeconomic results in like the last 40 years. Like we're just trying to understand the implications of this testing error in macro forecasting, which is really important because what I'm going to show you is that you need this high frequency information to even improve upon the random walk hypothesis. Okay, so this slide is super important. If you can get this, you can understand PEPS, right? I've talked about the bottom-up forecast. This is PEPS. So I start from a place of 1. I'm just running off this AR1 process recursively. So this is effectively like my daily forecast, right? So I start from 1. I'm forecasting the future. The future just is converging back to the historical mean with my autoregressive parameter. So this is my daily forecast. And then all I need to do is take the average of those daily forecasts to get the bottom-up forecast of the monthly average. Okay, so I do that. I take all these observations and I average them over the month, and that gives me this gray horizontal line here. Okay, so this is the thing I want to target. This is the thing I want to forecast. Now, there's 2 points on this graph here that I should need to draw your attention to. First, I star is the point in time within that month that the daily forecast is equivalent to the monthly average forecast. Okay, so this is interesting, right? It kind of makes sense, right? You have this daily forecast, you take an average, you know, at some point, those 2 lines intersect, okay? And that occurs on this day. The other thing that you can see here is that I can also say, take a linear interpolation of my end of period observations, effectively a forecast averaging. And this average of the 2 end of period forecasts is actually going to be equal to the monthly average forecast at some period. Okay, so this is the point in time in the month that a linear interpolation of my end of period forecast is going to be equal to my monthly average, right? And I call this I hashtag. So basically, this is super simple, but like super important, right? Because it says, look, I know there will be a day with like a point in time, a point forecast within a period that'll be equal to the monthly average. So I can either forecast the monthly average or I can forecast that point in time and they should be equivalent, okay? Same thing, I can just use simple forecast averaging techniques to reconcile end of period forecast with the forecast of the period average, right? And this is PEPS and PEPSI. So in fact, I can show you that you can actually even solve for these points in time, right? We know the daily forecast, we know the monthly average, we could just get a solution. Same thing if we have a weighted average. Here, my weighted average of my end of period observations is omega, right? We can actually solve for the optimal forecast weight. So you can actually get like a closed form solution to the equivalence. So this actually leads us to what PEPS and PEPSI are. And it's all motivated by the super important theorem in mathematics called the intermediate value theorem. So what's the intermediate value theorem? Well, it says, look, suppose I have some function that's continuous and I pick 2 points on that function, and the average across that function over between those 2 points has to intersect with that function, right? That is what it says. So what this is saying is that I star point will always exist, right? This is actually super useful because it says there's always a point forecast within the month that's equal to the monthly average. Okay, this is PEPS. If I can forecast I star, I can forecast the monthly average. The second thing is we can get that if the monthly average exists between a linear interpolation of those 2 points, we can also target the monthly average. And again, a simple application of the intermediate value theorem or like forecast averaging techniques. Okay, so in this example, all I would need to do is forecast, I just estimate a monthly model on end of month observations. The PEPS approach, all I need to do is forecast the end of month values using the latest information, right? So I construct an AR model at the monthly frequency, estimate my row hat here, and then what's amazing is that the statistics literature knows how to map between these aggregates and disaggregates, okay? And in particular, we know that this estimate of row from the end of month for the end of month model will be equal to row n, okay? So row raised to the power of n, right? So if n's 21 and row's 0.9, this is just 0.9 raised to the power of 21, okay? And what this means is that I actually know exactly how to construct a forecast of point I within that month, just projecting on the last high frequency observation, the end of month value, and this will give me a point forecast within that month that'll be equivalent that I can use to forecast the monthly average. Okay, so we can actually get a very clear closed form solution here to get that 1 point forecast within the month, just estimating the model at the monthly frequency. Alternatively, I could do PEPSI. I just take my AR model, I estimate it with end of period data, I forecast the end of period, I take my end of period forecast, I use nonlinear least squares to estimate that omega, or I pre-calculate omega computationally, and I use that to construct my average forecast that will be equal to the monthly average at that point in time. Okay, so it's actually quite straightforward. And this is the really amazing thing with this is I don't have to change the model. I don't have to use high frequency estimates. I can estimate all of, like, just take the same model I have, replace the average with end of month observations, forecast the end of month, and then reconcile those end of month forecasts with the monthly average forecast. You know, if you're a central bank, you have this quarterly DSG model, and you're estimating it and forecasting like monthly or quarterly average data, just replace that average data, like get your RA to replace the data with the end of period data, construct those end of period forecasts, And then you can just modify those end of period forecasts to be equal to the average and get all that high frequency information. Okay. So what's super cool about this is that it's actually really general, right? I mean, I've told you that there exists at least one point forecast within the month that's equal to the average. Turns out there can be even more than one. Okay. And in particular, I want to think, let's first start by thinking about a very special case where I have end of period forecasts. Now, why is this important? Well, the finance literature has forecast end of period values, right? So it'll have forecasts of end of period commodity prices or end of period interest rates, because again, they're interested in these point forecasts. So how likely is it that these forecasts from those finance literature are going to be useful forecasts for the monthly average? Okay. Well, it turns out that at long forecast horizons, right, as further I go in the future, they're going to converge. Okay, so your monthly average forecast and your end of month forecast will converge. And this kind of makes sense, right? You have an autoregressive process, you got a stationary process, you're forecasting out, it's going to converge to some long run historical mean. Both of these forecasts should converge to historical mean, okay? The second thing is that the autoregressive process, as it approaches a random walk, your end of period forecast is going to be a really good forecast of the average, okay? And then what does this mean? Well, I think about interest rates or commodity prices or exchange rates, all these things traded on financial markets that we use to construct our macroeconomic aggregates. These are going to be really close to a random walk. They're going to be exceptionally persistent at the daily frequency. And so the end of period forecast should just be a really good forecast of the average as kind of a first pass. Might not be the optimal, but it's going to be super close. The other thing is that we've noted in our recent publication in International Journal of Forecasting that in a lot of cases, it just sort of seems to happen naturally. Well, not a lot of cases. Specifically, we looked at oil prices. And if you look at the real price of crude oil, like that daily persistence kind of goes up and down throughout the month, but it's very persistent. It sort of looks like a random walk. And that average of that month, that first month, is equal to the end of period value for that month, right? If you had the daily data. So it can just be that the end of period is going to be equal to the average, but it's sort of a special case. We know it's true for crude oil. In fact, it's the only model when we looked at crude oil prices and tried to introduce high frequency information to all the different methods that exist out there, only using PEPS and targeting the end of period value was the only thing that was able to reject the random walk hypothesis, right? So super powerful. Okay. So the coolest thing about this method is you can still estimate the model. You don't have to change your model. You just have to change your data and then change your forecast afterwards, okay? So what's really great about this is I can use all the techniques that we still use in macro forecasting, right? So a very common practice is to backcast monthly values with historical data. So let's say commodity prices are all our daily high frequency financial data. This is only really available from the early 90s or like the mid 80s, right? And we really want a good value of the historical mean. So what we do is we backcast that data with old information that we have from monthly data. Okay, so this is very common practice. Well, guess what? Because we're just using monthly values, we can actually backcast our end of period observations. The second thing is that, like, one of the reasons we like to use monthly and quarterly frequencies is because, well, a lot of our information is only available at the monthly and quarterly frequency, which, is a bit of a problem for the bottom-up approach. The bottom-up approach, if I have a model with like GDP and say daily interest rates that I want to estimate at the quarterly frequency, I can't do a bottom-up approach because my GDP is only available at the quarterly frequency. That's not a problem for PEPS. I can estimate the model at the quarterly frequency. I can use data that I only have available at the quarterly frequency or monthly frequency, no problem, okay? So can we always solve for I star and I hash? Yes. I can solve for it. Getting the forecast for I star can be difficult and requires computational methods. So in practice, it actually turns out that this PEPS approach, just doing a forecast averaging, is very straightforward and it can always be done. Now, I've talked about all of this in terms of economic modeling and using just the simple ARIMA models and stuff like that. But actually, this insight's exceptionally important, right? You might be given a forecast and say, here's a forecast for some point in the future. within the next period, so say third day of the month, but you don't want the point forecast, you want the monthly average forecast. So you can actually use this information to know how likely it is that that point forecast is going to be a good forecast of the thing you care about, okay? And in fact, financial markets, in particular futures markets, give you a lot of good point forecasts, right? So futures contracts that say commodity prices, a lot of those are, settled and delivered on a specific day within a month. That contract is an expectation of that point in time in the future. And so we have a whole separate paper showing how you can take these future market point forecasts and construct really good forecasts of the monthly average, right? So if you're a central bank or you're an energy institution needing these commodity forecasts, and you're sitting on these free, freshly like minute by minute updated, futures forecast, you can get an exceptionally good forecast of the future just by reconciling the point forecast with the average. And I think there's a lot of interesting research to do on this, in particular using, say, like options to derive point forecasts of the future and using these point forecasts as forecasts of the average. Okay, enough of that. Let's look at some numbers. Let me prove to you how important this stuff is in practice, okay? So first thing I want to do is just do some simulation analysis. So I'm going to run some Monte Carlos. I'm going to just take that AR1 process, aggregate the monthly frequency. I'm going to look at 6 different types of forecasts, okay? So the first thing I'm going to do is I'm going to show you forecasts from like a simple ARIMA type model estimated on the monthly average data, okay? So I'll simulate a daily DGP using an AR1. So I'll have this daily data. I'll average it to the monthly frequency. I estimate my ARIMA 1.1 on that monthly frequency, and then I forecast the monthly average, right? So it's just straight out of the Box-Jenkins textbook, right? They say, you want to forecast the next month's interest rate, take that monthly data, estimate an ARIMA model, and forecast the monthly average. Well, why do we use an ARIMA 1.1? Well, people have suggested that when you aggregate an AR1, it aggregates to an ARMA 1.1. So you introduce these lower frequency moving average terms, okay? And some people think that this is sufficient to capture this high frequency information. Oh boy, is it not, okay? These approximations are absolutely terrible when the underlying data is persistent. They are not very useful, okay? The next thing I'm going to look at is an end of month no change forecast, okay? So this is going to be my random walk forecast. I should be able to beat this thing. I'm just going to use the latest information, do a no change forecast. Then I'm going to do my recursive bottom up, again, forecast the daily average X post. Then I'm going to just construct an AR forecast just on the end of period data, okay? So I'm just going to forecast the end of period. I'm not going to try to reconcile it at all. I'm just going to use that end of period forecast as the forecast of the average. So certainly don't expect this to be optimal. But then I'm going to use the PEPS and the PEPS approach, and we've already solved for that analytically. I've shown you the graph for that already. Okay, so what I'm going to do, I'm going to report the forecast in terms of the mean squared forecast error of these different 6 forecasts relative to the monthly average no change, right? So I'm using this kind of rough monthly average no change. This is what Menz and Rogoff and the entire commodity forecasting literature has done when they forecasted real average prices. Okay, so what people have done is think it's an interesting point of comparison, but we'll move on after in our application to look at something a little more serious. Okay, so what do I have here? This is sort of the table of the simulations. Each one of these rows are one of my 6 different forecast models, right? So here I have my ARMA 1.1 estimated with my monthly average data. And here I have different values of rho for my daily DGP, okay? So I'm simulating my daily data with these autoregressive persistence, estimating these forecasts using real-time forecast techniques, right? So I'm doing expanding window estimation. I construct these forecasts, and you can see that the Box-Jenkins, sort of the estimating this model with the monthly average data, seems to be able to outperform the monthly average no change. Why can I say that? Because this number is less than 1, right? This is a ratio of the mean squared error relative to the monthly average no change. So values less than 1 are showing accuracy improvements. And here I have like a 2.8% reduction in mean squared error relative to a monthly average no change forecast. Okay. So what do we see here? Well, I can get improvements upon the monthly average no change, up to 25% improvements at low levels of persistence, right? These really not persistent series, right? This looks kind of reasonable. This is what you get in sort of a Box-Jenkins style textbook, okay? What's going on here? Well, now I'm actually using the end of period no change forecast, okay? So I don't use the average, I don't construct my no change forecast with this monthly average data. I construct it using my end of month no change, right? If the underlying data was a random walk, this would be the optimal forecast. And what you can see here, holy smokes, this is a massive reduction in forecast error, right? Like 0.56 as a ratio means I'm getting like a 44% reduction in forecast error, right? Just by using at the end of period no change, okay? So like Box-Jenkins textbook, right? Like, holy, this is so much better. I don't even need a model. I could just use the end of period no change, okay? Now, wait a second, right? This is certainly not the optimal forecast. And as you can see, as the underlying data becomes less and less persistent, this is like not very useful, right? It's not getting, it's kind of saying that the future value is going to be equal to the last observation. It's not capturing the fact that this thing's going to be converging to historical mean. So when the underlying data isn't very persistent, this end of period no change obviously becomes less and less relevant, okay? Okay, but what happens if I just take the end of period data, estimate that AR1 model on the end of period data and construct a forecast? Wow, look at this. I have a forecast model that gets massive, again, like 45% reduction in mean squared error at the one step ahead, and huge reductions in the mean squared error, even when the underlying data isn't very persistent. And what's crazy about this is this is not even an optimal forecast. I'm just using a model of the end of month, forecasting the end of month, and using that end of month forecast as the forecast of the average, right? This is like what I said, I could use some financial forecast and use that exact forecast for macroeconomic data. It's still going to be pretty good when that underlying data is really persistent, okay? So these are like what people can do. Then this actually turns out to be a bit of a problem, okay? So do you want to know how to get any forecast model to look good? Well, you forecast an average, compare against an average no change, and just estimate the model with end of period data. It's spurious, but you could literally get any model to show 30, 40% forecast gain. I mean, literally, you could just like take the data, add noise to it, and you're still going to get massive reductions just by estimating the model with end of period data, right? So people have discovered this. There's a lot of, I know researchers out there and a lot of papers out there that say, I want to forecast the average future value of this. And then they go through all the theory, they show you why their model is super cool. But what you sort of miss is when they say, okay, now I'm going to estimate the model with like, say, end of period data, right? And but I'm still going to forecast the average. I'm still going to pair against the average, no change. Well, you're getting these gains, even though like as a spurious artifact of temporal aggregation bias, okay? Like this is not an optimal forecast. It may not improve upon the like end of period no change forecast, right? The optimal random walk, right? But you can always show 20, 30% gains in forecast accuracy just by estimating a model end of period data and not actually testing it properly. Okay, so I think editors and referees as peer reviewers, we need to be aware of this. If you are doing this in your own research, you need to take this, you need to understand why this is working. And I think this theory here that I've laid out is an important to sort of understand why that typically works, but also understand that it is completely spurious and that you're not actually testing it correctly, and that you actually have to test against the correct random walk hypothesis to avoid spurious predictability, okay? But again, this is just the end of period observation. How does that compare to, say, using an optimal bottom-up forecast, right? Well, the bottom-up forecast, again, 56% reduction in mean squared error. 46 reduction in mean squared error. So again, like huge gains. This is the optimal forecast, right? Like doing the bottom-up forecast clearly outperforms all these other things. Lucapol said this should be our optimal forecast, right? And you can see that like the PEPS approach and the Pepsi approach, they gave you the optimal forecast, okay? And in particular, actually, in some cases, we have even better, less dispersion in our forecasts, because one of the cool things about PEPS in practice is that when you estimate this error model to daily frequency, you know, that if that value is close to 1, you get downward bias in that parameter estimate. But because you're estimating like rho to the power n, it's further away from 1, you get actually less downward bias of your estimate, okay? So there's actually some reason to actually find that the PEPS approach is actually going to outperform in finite sample, okay? So PEPS is optimal. We've proved it in theory. We've shown it graphically. Now I've shown you the simulations, and I've given you a taste of how massive these forecast gains are, right? Like 46% reduction in mean squared error is massive, right? Like if you can find like say 4 to 7% reduction in mean squared error of like the S&P 500 forecast, like you could publish a paper, right? Like this is an order of magnitude larger, right? We're 40 to 50% reduction in mean squared error. Like this is of first order of importance. Okay, so that was some simulations, but what about in practice? Okay, so I've got this, in the paper, I've got much more applications, better, different GGPs. We look at directional accuracy, also alternative forecast metrics. I've got other applications, but here I just want to show you forecasts of monthly average real copper prices. If you look at the World Bank pink sheets, again, these are just monthly averages of daily closing prices. So I'm taking my daily closing prices from the London Metal Exchange. I'm going to see if backcasting helps. I'm going to forecast the real value. So I'm going to deflate by real-time CPI vintages, right? So I know the CPI data that was available at that month. I now cast it. I used that data before it was revised. So I'm only using information that was available at that point in time. It's really important because this means that these forecasts are actually like relevant in practice. Someone could have constructed this model at that point in time because I'm only using the data and estimates that have that information at that point in time, okay? So I have this daily data back to January 1990, but I can backcast it actually back to 73. So I'm going to see if that helps. I'm going to forecast the last 20 years of the monthly data. And I'm going to look at two forecast models. One is the univariate model. So just, again, sort of an ARMA type application, right? So I'm going to estimate some ARMA model, forecast the monthly average. And I don't expect this to work very well, right? I mean, I'm just using univariate information. But the second thing I'm going to do is I'm going to look at a bivariate vector autoregression. Okay, so I have two equations, and each equation will have legs of the copper price and legs of another predictor, and that predictor is the OECD composite leading indicator. Okay, so this is available in real time. It is an excellent leading predictor of business cycles. And, you know, this is a great case, right? Where I have this monthly VAR model, right? Where with an OECD composite indicator and some price variable, and it would be, I can't even do the bottom up approach, right? Like the OECD composite leading indicator doesn't exist at a daily frequency, right? I only have monthly data for it. And so this is where PEPS is going to shine, okay? Now, the one thing that's different between what I'm doing in the application and what I've done in the simulation is I'm actually going to test against the random walk hypothesis. So I'm going to compare not to the monthly average no change, but the end of month no change. And this is going to be the first test of real copper prices against the end of month no change. Okay, so what have I got here? Well, it's very similar to what I showed you before. And I have my mean squared error ratio relative now to the end of period no change. Okay, I have my different models on the different row, but now my columns are the different forecast horizons, right? So my 1 step ahead, my 12-month ahead forecast accuracy. And again, let's start with the ARIMA stuff. So if I estimated an ARIMA model on the average data and then forecasted the average, it's terrible, right? Why does this look so bad? Why is it 1.7, like 70% increase in error, precision errors? Well, it's because I'm comparing against the end of period no change, right? And it looks really bad when you do that because the end of period no change is very accurate. It's a good approximation when the underlying data is very persistent, okay? And I've done a backcast here, and you can see like the error isn't as big at longer horizons, right? And this is important because that temporal aggregation bias will be the largest at short forecast horizon, okay? Now, if I use the PEPS approach, right? So I take end of period forecast constructed from a model that was estimated with end of period data, right? This is like my last row here in the top part, right? I do really well, all right? I get some convergence, but this isn't the optimal forecast because that end of period forecast, I haven't reconciled that to be equal to the average. So if I do that with the PEPS approach, I can improve in accuracy. Okay, so here I got 7% reduction, even with the simple AR model. That's actually pretty good. And here I have the Dybel and Mariano p-values, so you can see that I could even reject equal accuracy relative to the end of period no change. So I can reject the random walk hypothesis at the 10% level. Okay. Now, these bottom rows basically show you the same thing, but without backcasted data. Now, this is important because the bottom-up approach, like I can't backcast my daily data if I don't have daily data going back further. So I can't actually backcast in this case. And you can see the bottom-up approach does pretty good. But actually, at the 1 and 3 month horizon, the PEPS approach is still outperforms the bottom-up approach in practice, okay? So, and you can see here that one of the things that we're losing at these longer horizons is a good estimate of the historical mean real price of crude oil, right? So, it's been argued that like the real price of commodities should be stationary. And so we backcast our data typically so we can get a better estimate of that long run mean. And you can see here, like our long run forecast over the same forecast sample are going to be a lot better if I backcast my data and get a better estimate of that long run mean, okay? So backcasting, it's a nice thing to do. You can see the gains at the long forecast horizon. Now, let's look at our VAR, okay? So again, just 2 equation VAR with the composite leading indicator and my copper prices. And if I was just to this is what sort of central banks do, right? They got this, structural type model, like the DSG model or structural VAR. They estimated with this monthly data or quarterly data. They forecast, and it turns out to be a terrible forecast when you test it correctly against the end of period no change, because you've thrown away all this recent information in the recent copper price movement, okay? So this VAR, again, doesn't do very good, but at longer horizons, you can see that this composite leading indicator is kicking in and giving you some forecast gains. Now, if I just took that exact same model, but instead of estimating it and constructing forecasts using the monthly average data, what if I used just the end of period data and constructed that forecast? Well, here you can see it does pretty good. Like I can just do end of period real copper price forecast, and it looks pretty good, right? I can get some medium run gains. Yeah, end of period forecast can be good first approximations of a monthly average. But if I take that exact same model and I take the forecast, the exact same end of month forecast, and then I reconcile those end of period forecasts to be equal to the monthly average forecast, wow, look at these forecast gains, right? 15% at the 1 step ahead, right? Like 22%, like 27% at the 6 month horizon, right? These are enormous gains in forecast accuracy. And the only thing we did is we just estimated the model, like but the monthly frequency. And all we did is we took those end of month forecasts and made them equal to monthly average forecasts, right? So here you can see, you got huge advantages of being able to take whatever model you have now, changing the data, doing those end of period forecasts, using them alone, or making sure you reconcile them with the monthly average forecast, and you get massive forecast gains. Okay, so yes, everyone I think would like to see 20% gains in forecast accuracy. Okay, so what do? We propose PEPS and PEPSI. Okay, these are methods to basically take the exact same monthly and quarterly forecast models that you have, change the data to the last point sampled observation. Here we're constructing a forecast using all the available information at the end of the month. So I've used end of month information. And what we've done is we've shown different ways to construct point forecasts using that end of month observation that are equivalent to the monthly average forecast. Okay, so the real thing here is we get these enormous gains in forecast accuracy that people have recently shown exist with this daily to monthly or quarterly aggregation, right? You want to use that high frequency information. You want to use that end of period closing price. The accuracy is in theory can be equal to the recursive bottom-up approach, but in practice, we often find it works better because of several practical advantages in finite sample. So, the other thing here to take away is like, you can see the value of having this high frequency information, right? We didn't have, Menz and Rogoff lamented not having end of month or daily effective exchange rates to be able to, construct a forecast. Well, we can actually see that we should expect like enormous 40–50% gains in forecast accuracy if we had that information, right? So, macro is moving in this direction where we're getting like daily CPI measures, daily effective exchange rate measures, and, you're going to be able to get daily consumption and investment measures going forward, right? Because we can see how important it is in terms of preservation of information in forecasts, and this is going to lead to better decision making. Okay, so the big thing here is if you want to check this out further, I'll be posting some short courses with some code walkthrough. I've got replication information on my website with code to actually implement this in R and Stata. I've also got a treasure trove of end of period effective exchange rate data. So yes, I did actually go and calculate it. I've got end of period commodity price data on my website. So go check it out, download it, use it, implement these methods, and you can be the hero for whoever you're constructing your forecast for. So thank you very much for your time. Like and subscribe because I'll have more short courses and code walkthrough in the future. And so hope to see you around.